Welcome to Bloomberg Markets. From London, I'm Dani Burger. Stocks in Europe and Asia on the rise after China rolled out another round of support measures for its embattled property sector. U.S. markets are closed for the Labor Day holiday. Plus, a high-stakes meeting in Sochi. Turkey's president looks to persuade Vladimir Putin to revive a UN-backed grain deal ahead of a G20 meeting later this week. And we're live at the scene of Germany's International Motor Show. We spoke with CEOs of some of the world's largest automakers. We'll bring you highlights from those conversations coming up. Well, the U.S. might be closed, but as the big market driver, China takes the mantle. It was a positive handover thanks to more policy announcements coming from the region. That's helped to support European stocks, bonds. Those are seeing declines this morning in Germany as the euro also gains this morning after strength coming from the dollar on Friday after a positive jobs report. NYMEX crude, that also trades at a November high. So what we're seeing in Europe with the German two-year yield above 3%, it's a little bit different from what we saw on Friday. It was a story of stagflation fears gripping European bond markets, with Morgan Stanley saying the end of the rate hike cycle for Europe is upon us. Let's get more on that. Joining us now is Henry Ockelson, European macro strategist at Macro Hive. Henry, let's just start with this call, plain and simple. Morgan Stanley says that because of weakening growth and inflation, which is on a downward trajectory, the ECB is done. Would you agree with them?
So our lean at this stage is that there's probably more hiking to be done by the ECB. I think it's a hard call at this stage, particularly for the September meeting. One of the main reasons that we have higher conviction that more tightening is needed is because the ECB has been pretty unequivocal of focusing on their inflation mandate as opposed to their anything around growth or employment. I think the stagflation argument is definitely gaining ground. The minutes mentioned it a lot. Schnabel's comments last week, I think, played a decent role in setting out the sort of neutral ways for and against hiking. But I think that needs to be taken into account or sort of context with a couple of other things, which includes the fact that it seems she's towing the line much better in terms of not shifting too hard one way towards a hike or towards a pause than some of her colleagues. And I think that's reflected in what was agreed at the minutes or sort of at the last meeting. And the main sort of burning question is employment and the tightness of the labor market. So if we consider where Europe stands right now, they're in a situation where, despite the PMIs, for instance, being incredibly negative, the overall employment growth is slowing but continuing, which is quite sort of at odds with previous sort of recessionary sort of situations. And when we look at their forecasts, which is going to be one of the things that they're really going to sort of lean on with regards to the decision, the reason why they revised up their forecasts so much more hawkishly, and that had been kind of our argument since the start of the year that they needed to, back in June, was on the basis of unit labor cost. So if you're having a tighter labor market, slower growth, that is low productivity, higher wages, and higher unit labor costs. So it's going to be a hard one for them to balance that and try to lean towards a lower medium-term core inflation rate that would sort of justify that pause. So at this stage, we're sort of much more 50-50 than markets pricing, at least.
Okay, well, then can you have any conviction then, Henry, if you're 50-50, at least on that front, on what happens on the front end of this Bund curve? Because German two-year yields, they've really been stuck between let's call it 2.9 and 3%. They've struggled to go anywhere. Where's the next breakout?
So, I mean, whilst sort of on the September we're 50-50, I would say definitely our lean is more towards that they will, one, they're going to be a sort of a terminal rate of at least 4%, seems kind of much more reasonable from a fundamental perspective. And two, the cuts that are priced into next year, so 2024, seem to have been driven partly by just what's going on in the US, as opposed to the kind of fundamental story in Europe. So we still, I mean, our lean is very much towards short the EGP short end and sort of paying rates there at this stage. Further out, I think further out the curve, I think funds have been relatively well capped in terms of yield terms, just by the fact that there's clearly, I mean, they're still at very high yields versus sort of historical versus what sort of market I think is used to, and the fact that supply has really, despite German growth being much lower, the Finanzagentur has managed to sort of really not need to expand supply. Particularly, we've had no real breakouts or blowouts in EGBs more generally in terms of spreads, partly on account of sort of TPI, but the story there seems a lot more stable, and inflation expectations definitely into that kind of sort of part of the curve are a lot more capped than say, would be the case, I'd expect, in the US, for instance.
So Henry, if I can go back to one thing you just mentioned there, the cuts that are priced in for next year being much more driven by the U.S. Is it your estimation then that the ECB won't be cutting next year? And is there a risk then that policy is unduly tight if we're in an environment where perhaps the Fed is cutting at the same time?
So I mean, so our lean overall is that is more hawkish, both Fed and ECB. I think from a relative perspective, the better value would be the comparison between UK and Europe. So for context, the Bank of England, very little priced in terms of cuts next year, almost 3 hikes priced in till they sort of reach terminal rate. And that's sort of sitting in contrast to a Europe where unemployment's still very low, core inflation and particularly wage-intensive inflation in services in the services sectors is still, the momentum is still decently above target. It sits quite sort of at odds with each other. So we quite like that play of being sort of positioned for a sort of UK steepening versus European flattening, for instance, in that respect. In terms of will the ECB cut next year, I think obviously a lot can change within a year, so it's very hard to make a very strong call. But I think in the near term, the ECB is certainly going to be pushing back on that pricing. We heard Schnabel already sort of talk about the fact that the market basically being more dovish on the rate further out is taking out some of the tightening that they'd like to see. And I think that tone is going to basically continue. So even if they were to pause in September, they're going to be doing everything they can to sort of shift it towards a very hawkish pause and basically dampen that kind of mood at this stage, because it doesn't help them doing their job basically.
Right. What is a China that struggles to get economic growth off the ground mean for Europe in the midst of all of this, Henry?
Yes, I mean China is obviously a stronger China would help European exports, autos, manufacturing, machinery in particular. That being said, I think the weakness of the global market, I think, is probably less of a risk to European manufacturing in particular than just the systematic changes in the structure of the European economy, from higher energy prices and a much more competitive Chinese auto sector. So things like batteries, EVs, China is doing incredibly well in sort of surging ahead, almost taking sort of second mover advantage versus elsewhere, whilst Europe is comparatively having a much harder time on that front. So I think all things equal, a stronger China should help European exports. But you also need to look at where the Chinese growth is coming from. So if their consumption is more shifted towards services, that benefits Europe less. And equally, as we've seen with the support last week, if it's all around housing, getting first-time buyers more into the market, supporting parents, for instance, that's going to have less of an impact on the European exports than other measures would have. So I think there is nuance to it at this stage, and it's not an entirely positive story.
I mean, the nuances are screaming from the macro picture, Henry, because I look at things, for example, not just China growth, perhaps not living up to expectations that we had this year, but things like, for example, if India's GDP set to grow at 7%, while at the same time Sweden and Chile are set to see their economies shrink this year. How much of the end of 2023 and 2024 is going to be about this global divergence of growth? And are there any screaming buys or sell to you within that context?
So, I mean, I think the divergence in certainly the European context is going to be a lot around energy intensity. So I suppose I've said it like already, but it bears repeating just how structurally changed the the European energy market is now versus it was before Russia's invasion of Ukraine. They're now much more exposed to sort of global markets in terms of LNG, for instance, as we saw with Australia strikes. Australia doesn't really export any LNG to Europe, and yet European gas prices were rising on that, and that's partly just that exposure to LNG rather than piped gas is going to make us more global, sort of exposed to global markets. And it's the same with geopolitics. So there's going to be a lot of concern, I think, in Europe, particularly European industry, around securing securing supply for energy and insulating against kind of the sort of geopolitical upheavals that we might see particularly in the regions where Europe does buy a lot of energy from. That's certainly within the European context. From an international perspective, I think whilst I'm sort of not that au fait with Indian and Swedish growth, certainly one of the themes that we've been seeing is around and in terms of sort of particularly on equity side, European equities in a sort of stagflation environment, we'd be sort of more bearish on, particularly things like home builders, for instance, probably value being more long sort of staples versus that in that kind of environment. And the overall sort of politics in Europe has definitely, and we've sort of been flagging this for a while, had a much stronger lean towards targeting profits.
Okay, Henry, I'm afraid we're going to have to end it there. But Henry, thank you so much for joining us. Really appreciate your thoughts this morning. Henry Ockleston of Macro Hive. All right, let's get further in, more global into this markets conversation. Pick up where Henry left off. Joining us now is Bloomberg MLive's Eddie van der Walt, who joins us. Eddie, I got to start on China because the European handoff seemed very positive on, I guess, a drip feed of China measures and perhaps signs of growth. But, I mean, do you look at this and say, it's Labor Day holiday in the U.S. Maybe we don't believe the market action too much?
You know what, Danny? I heard a really good one in the newsroom earlier, with one of my colleagues saying that this is starting to look less like a big bazooka, but more like a machine gun, right? They keep firing more and more bullets at this problem. I don't think it's really a drip feed anymore. You can't really say that because measures that they are taking are substantial. And if these had been announced in one single package, I think the market would have been almost overwhelmed. And I think people are cottoning on to that fact. These are substantial measures that China is bringing in. That supports the Chinese economy. That supports European growth because Europe exports a lot of its, stuff to China. A lot of German factories making high-end equipment that ends up in China, making goods that gets re-exported to Europe. So I do think this is a very significant turning point for the European economy as well.
I saw this great piece essentially arguing, Eddie, that the best growth stocks, it's not U.S. tech, it's French luxury, that's where it's all out. Only a minute here, Eddie, but translate that into this equity market rally. Is it going to be Europe's time to shine?
Look, Europe is overdue a time to shine, right? I think European banks have been struggled for a while under inverted yield curves, negative rates, all of those things. But also, as you say, luxury. Luxury is a big thing because Europe is good at making luxury. They are good at exporting that to China, and they are good, but also to the rest of the world. However, you do need to see strong Chinese demand to make that work. So that is the big missing piece in this puzzle, is it strong China.
Eddie, thank you very much. As always, Eddie van der Walt on the not just markets, but, luxury beat. That makes sense. All right, coming up, we're going to be going live to the IAA Auto Show in Munich, where we're going to discuss, among other things, EVs and the European market. This is Bloomberg. Welcome back to Bloomberg Markets. A positive day in Europe. The U.S. might be offline, but that's okay. We're doing all right without them. It's the positivity coming from China. Just talking to Eddie van der Walt about this. Maybe it's not fair to call the policy measures a drip feed. Maybe it's to say it's not a bazooka, but it's a machine gun. In other words, it's a lot of smaller measures that impact in a big way. And that big way is being reflected in what's happening in Europe. The euro strengthens this morning. We're not at 109, but we are back at 108. We did see a strong dollar following Friday's jobs reports, and concerns about stagflation in Europe meant that the euro had been weakening. It meant that two-year yields had also been declining, but the opposite of that is happening today. Meanwhile, NYMEX crude trades at a November high. All right, autos are also in focus this morning. Bloomberg's Oliver Crook is at the Munich Auto Show. Oliver, I know you're at a distinctly European auto show, but you and I were just talking about this during the break. How many Chinese automakers are there?
That's right, Danny. It's really an international motor show this year, and it's really the Chinese who are here. They've doubled the number of people. We're right now at the stand for BYD, which, as you can see, is absolutely mammoth. They're really trying to put their stamp on the auto show here. Why? Because they're trying to break out of the Chinese market. After toppling Volkswagen as the #1 brand in China, they're trying to go out into Europe and try to enter this market and really build brand awareness with the consumers here in Europe. And so we spoke to a lot of different executives about this, and I caught up with the Volkswagen CEO, Oliver Bloom. I talked to him about all of this and the economy in China.
The auto show in Munich, the IAA, is a great opportunity, first of all, for the German automotive industry to show the progress in terms of technology. But we have guests, visitors from all over the world, and for us it's a good opportunity to share experiences, how we will develop the mobility of the future. In terms of Volkswagen Group, we have the opportunity to show the progress in Volkswagen Group. I'm in charge since 1 year, and yesterday, the Group Media Night, we presented the progress of our 10-point plan, how we are, what priorities we are taking in terms of products, finance, regions like China and North America, software, technology, our platforms, mobility services, and sustainability. And so for us, it's a huge opportunity also to show a glimpse what products our customers can expect in the future. Very promising, and I'm looking very much forward to it.
Right, and a year is a long time in the auto industry, particularly right now. A year from now, what will you be hoping, where do you expect Volkswagen to be, and what would you want to be speaking about at the Munich Auto Show then?
Yeah, we are updating our existing platforms in terms of electromobility. For example, the MEB in Volkswagen called MEB Plus. Yesterday we have shown a glimpse with an iconic GTE brand, what customers can expect in the middle of this decade. Next year we will come with the new platform PPE for Audi and for Porsche. In the background we are showing the Audi Q6 and driving this car, testing this car. It's so promising and exciting what we bring there. And then developing fast our future unique platform, SSP, with a lot of stunning projects. And so I think you can expect a lot from Volkswagen Group during the next years.
And what is the consumer changing? What are they demanding from you now, and how are you meeting that demand?
We are in the middle of the transformation, and it is about electrification, digitalization, connectivity, autonomous driving. And I think Volkswagen Group is well prepared. On the one hand side, we have traditional strengths in terms of driving abilities of our cars. It's a high quality level we do have. Then yesterday we announced that we move Volkswagen Group to a design-driven company. We are very strong on design, and that will be an important differentiating factor for the future. And combining this with new technologies, developing our platforms and combining this with partnered solutions in the different regions of the world, being able to offer the ecosystems our customers are expecting in the different regions of the world.
So the Volkswagen CEO there talking to us a little bit earlier about their plans. How do they stay on top? How do they continue leading in a market that they're increasingly falling behind in, certainly in China, but more generally in the EV space? I mean, we have Mercedes, BMW, Renault, Opel, all launching new concept cars for their vehicles, but these cars are not yet ready for market. Where we're standing right now at the BYD stand, these cars are here. They are really ready to break into this market. The question is, when will they start building manufacturing capacity here in Europe?
Well, I mean, to that point, Oliver, VW fell, what, 4% on Friday off the back of that UBS note? I mean, some pretty harsh words, not just on VW, but Renault too. The analyst over there saying, look, there's just no way they can continue to live without that competition from China. I mean, is that the talk there? Is the assumption that VW and Renault, once they get that manufacturing capacity, just can't keep up?
So listen, I asked the Renault CEO just about that. He said that the rumors of my death have been far exaggerated. So listen, this UBS note was very, very scathing. It was really sort of a eulogy for the legacy car makers in a lot of ways. Let me just go through some of the main points. Basically, because the Chinese automakers, BYD specifically, have such a cost advantage, 25% over that on other models, that they're really just way ahead of them. And so by the time in 2030, the Chinese will basically double their capacity of global market share. And that means that 20% of legacy automakers' market share will be lost in that period of time.
Yeah, massive. Okay, so in the meantime, a lot of the conversation, again, Oliver, has been about China. But let's go back to the European automakers. What sort of conversations have you had just specifically about what they're doing and where the industry goes?
Yeah, so listen, the other backdrop around this is, like, let's not forget, on Friday, Tesla cut prices yet again. You know, they sent out their Model 3 revamp, and this is all sort of mounting pressure. And a lot of the executives I've been speaking about are concerned about the darkening macro environment. We have had a huge order backlog for a lot of these European automakers. That's really kept the numbers up and the deliveries up. But longer term, it's not very clear kind of what the outlook is looking like here.
Yeah, certainly not. Hey, Oliver, I also got to ask you, what cool cars have you seen? Anything there that's kind of surprised you?
Yeah, so listen, Mercedes, I think for the Bloomberg audience, they've teased their baby G-Wagon. That's going to be coming out at some point pretty soon, and I think that that's going to be probably a very big seller. The Mercedes AMG GT63, I was informed, unfortunately, it's like 200 grand, so probably a little bit out of my range. But even these BYDs, which I haven't seen in large volume, they're really nice looking cars, so there's something for everybody here.
Yeah, there certainly is. Look, I was in Vietnam 2 weeks ago. Everyone was really excited about BYD, not necessarily that, other Asian electric car makers that debuted in the U.S. Hey, Oliver, great stuff. We're, of course, going to be with Oliver Crook back at the Munich Auto Show throughout programming. A lot more conversations to come and a lot more executives to talk to. Will we see Oliver give us a test drive of the baby G-Wagon? You know, all of the important questions. Okay, as we go to the break, let me show you where markets are trading. Again, the U.S. is off. It is the Labor Day holiday. Doesn't mean that the U.S. isn't any more important. We have that jobs data in hand. How comfortable are you to trade with the view that the Fed is done with its rate hike cycle? Does that mean you want to position into steepeners? Remember, this week, starting tomorrow, we're going to be getting a deluge of corporate issuance. It's something we typically see off the back of the Labor Day holiday. Last year was $35 billion worth of IG bonds that were issued on the Tuesday after Labor Day. So that could really put a pressure on duration. Elsewhere in this market, it is the unwind of the Friday trade for Europe. That was euro down, stocks down. Today, it is European stocks up, euro stronger. This is part of the reason why. It is China and it is stimulus. We've had a lot come out of them from things like lowering mortgages, making it easier for first-time home buyers, really targeting that segment specifically. Sure, country garden fears are still in the fore, but it was enough to really get this market going. The CSI 300 up 1.5%. Hang saying it was off on Friday. But here's the rejoin. Here's the catch-up trade, 2.5%. Coming up, we're going to talk more about those property stimulus measures in China lifting sentiment. We're going to be speaking with Miles Yu, Hudson Institute China Center Director. That conversation is next. This is Bloomberg. Welcome back to Bloomberg Markets. European stocks are up, halving some of the losses we've seen over the past 3 days. Euro is also trading higher thanks to the positive handoff from China. Stimulus measures there supporting global risk sentiment. Now, speaking of China and industry, they're inching into Europe when it comes to autos. Let's go over to Bloomberg's Oliver Crook, who's at the Munich Auto Show with a special guest. Oliver.
Hey, Dani, thank you so much. Yes, I'm joined now by Michael Shu. He is the Managing Director for BYD here in Europe. Thank you for joining us today. We're here at your massive stand here at the Munich Auto Show. You've done an amazing job really conquering the market in China. Now, are you ready to take over, to enter the international market?
Thank you, Oliver. Actually, yes, and we've got a very good marketing performance in China in the past 2 or 3 years. And we found the market love BYD's technology and the product so well. And so we are trying our best to introduce those technologies and the products to overseas market. And definitely Europe is our strategic market. And we want to try, we want to communicate with the customer here. And let's see, the IAA is a great opportunity and to have this conversation. We love to be here and to hope every customer in Europe can visit our booth in Munich.
And so what markets will you be focusing on? What countries in Europe will you be starting in?
You know, Europe is a very big market, and following China, it's almost the biggest market for a new energy vehicle, just following China. So we do think the customer here is more environment care and more technology care. And also German is the biggest market in Europe. And we generally don't have very focused market in Europe, but we want to communication with all the European, pan-Europe market.
And so how are the customers, how are they finding your cars? What are they liking about BYD that maybe some of the other cars don't offer?
Actually, BYD already invested in new energy vehicle technology for many years. And we invest not only the product itself, but also the key technology inside, the battery and the powertrain, the telematics, and we have full technology vertical contribute the product. And so that can bring our customer different experience, because with that, customer can get safety is our first priority, and with the technology based on the battery technology. And secondly, is the premium design of the car, but with accessible price.
And yeah, so price is going to be a very big issue, but also one of the issues you may face in Europe is brand awareness. How do you build the brand, the BYD brand in Europe? How do you get it in front of people's eyes?
Yeah, actually, we already, step one is through this kind of auto show. I think it's 100,000 of people we're visiting here. That most of them are industry people, right? And also some of the consumers. They come to our auto show to test BYD's car and to look at compare the technology and the product and with the industry partner. And also, and we already have good partner in different countries with 150 stores in pan-European, and people can get into the store and to try BYD's products.
And at a certain point, when you really want to build market share, you're going to have to build factories in Europe. Have you thought about what countries you'd be looking at to build manufacturing capacity?
Definitely, localization is one of the very important strategy of BYD's Europe strategy. And so we are considering, we're evaluating different locations in Europe and where we can build the cars. We hope, we're targeting, and we can have some announcement at the end of this year.
Yeah, this year. And you've had constructive conversations with different governments?
Yes.
And they're very happy to, they're excited to see you come to potentially build factories.
Yeah, we are so welcomed by different countries, yeah.
And then have you also studied sort of the Japanese and Korean car makers? It took them a very long time to enter the European market. How are you going to not have the same challenge? You know, how are you trying to go around that to not have the same problem that they had?
As a new brand of the car maker, and yeah, we studied some of the history, but we more studies about the people's, how they like the new technology and how they like the new technology bring them the value. And if we are confident we can bring them value, and we think the timeline will be shorter, will be speed up. So currently we have very good progress within 11 years delivery the BYD's car in Europe, and the feedback from the customer is so positive. And so we are confident the lineup of compared with other Asian brand of BYD will be faster.
And can I also ask you, in terms of for example, the Russian market, which obviously has no Western players, where does that fit into your European strategy?
So far, we are still making the plan, but not have exactly planned yet. No.
And that is Michael Shu. He is the president of BYD here in Europe, joining us here at the Munich Auto Show at their massive stand here, really trying to build that brand awareness around the European consumers.
Yeah, Oliver, fantastic conversation, a timely one, too, as we look at the industry in China. Thanks so much. That's Oliver Crook. Let's talk more about China industry and the geopolitical side of it. Joining us now is Miles Yu, Senior Fellow and China Center Director at the Hudson Institute. Miles is an expert on China, also previously served as a China advisor to the White House under Trump and Secretary Mike Pompeo. Miles, thanks so much for joining us. Look, for the first time since taking over the helm of China, of the lead position there, he's not going to be attending the G20. What do you make of that as a shift in his approach to geopolitics? Is it a shift?
Well, it's kind of a very subtle message. That is, this is the G20 is going to be hosted by India, which is a core member of the so-called BRICS. China has played a lot of hope on this BRICS as a coalition against G7 and the American-led the Western free market system. So, the G7, the BRICS just had a summit in Johannesburg, South Africa, and Vladimir Putin couldn't go because he was wanted by international criminal justice system. So I think this is probably, I think Xi Jinping is going to give Putin some kind of consolation award. That is, listen, you couldn't go to South Africa, and I'm not going to India. So this also, I think, indicates there's an internal strife for leadership within the BRICS. So there's a clash of ambitions there.
Does it not make relations with India more complicated, Miles? I mean, he's supporting BRICS. Modi was, of course, at the BRICS summit, too. But this time the G20 will be in Delhi. I mean, does that not complicate relationships there?
China-India relationship has already been very complicated and also very direct. I mean, people spend a lot of time focusing on the crisis, the tipping point of the explosion over the Taiwan Strait. People often forget that China and India have this very tense border dispute right now that could erupt at any moment. Both countries are building up military capabilities along the very disputed border. So I think, since 2020 in particular, after the clash over the Ladakh region, and China and India, they're like one step beyond Cold War. It's a little hotter than Cold War. So what I'm thinking here is the smiling faces between Modi and Xi. They're just on the surface, and below that, the very thin layer of surface is enormous tension and hostility toward each other.
There was this moment really when Xi first came to lead as president of China, when he almost had this reputation, or at least an image of a global peacemaker. He went to all the G20s, after the 3 years of COVID isolation, going to the G20 meeting in Bali, talking about trying to facilitate some peacemaking between Ukraine and Russia. Is there any degree towards a pivot of that, of focusing more perhaps on domestic issues, of not going to the G20?
I think China is a very important country geopolitically and economically as well. So China definitely has this impetus and the potential to be a global leader. China, in terms of its population, its economic size, its military development, and its position at the United Nations. The problem is not that. The problem is China lacks two things to be a global leader. Number one, China does not have the credibility. I mean, if you want to be a peace broker, you have to be really fair, and you have to really make sure that people are convinced that you're fair. I mean, over the issue, for example, like Ukraine, China is decidedly on the side of the aggressor, on Russia's side. It's not going to work. China also said, hey, listen, you got to really respect each other's sovereignty. That sounds very good, but China does not respect many of the neighbors' sovereignty. China has border disputes with its neighbors than any country in the world. I mean, talk about South Korea, Japan, Vietnam, Philippines, India. So this is a problem. So does not have credibility. Number two, China really do not have the credential to do so. I mean, China makes a lot of promises over there, over issues like Hong Kong, the high degree of autonomy promises. It keeps breaking. It keeps breaking it. So that's why it is very hard for me to see China had this ability to lead a large portion of the world with convincing value and convincing credibility. And also keep in mind, China's coalitions, many of China's allies, they have their own designs too. It's very hard to imagine that Russia and India will concede to China's leadership on the stage.
Miles, I mean, just given that you are an expert in military and in naval history, especially as it pertains to China, how worried are you about a military conflict that is either started by China or involves China?
This is not just America's problem. China has a ambition for global dominance. Right now, you can see mostly through the economic march into the global key markets. You just had this BYD official. I mean, he talked on Germany, and he's contesting the predominance of Tesla and also traditional automobile industry. So you can see that. And in the meantime, Tesla has a problem in China because government has a profound distrust of Tesla. Government cannot use Tesla cars because of its international connectivity. So I think, you talk about the military. Military is a concern differently. China has made a substantial advancement in key technologies of modern warfare. In some of the new arenas, they're very good. So, but again, it's not just the United States. Every country in the periphery also should worry about China's rise in military. Europeans also take note of that. NATO is in particular.
Miles, we only have a minute here, so we have to be quick. But in a world where China does go that way, is China economically prepared to face the same fate as Russia, that is, being cut off from much of the Western world?
All depends on China. If China takes some military actions, for example, against Taiwan, that sanction regime is going to be very, very quickly imposed on China. And unlike Russia, China's connection with the international free trade system is much more intricate and comprehensive. So the impact on China's economy is going to be much more catastrophic.
Miles, we really appreciate you taking the time on this Labor Day holiday. Hopefully you get to go out and enjoy it after this. Miles Yu of the Hudson Institute, thank you so much. Now, there is positivity emanating from China, at least from now, thanks to some of the stimulus measures. European stocks and euro stronger today off the back of that. Now, coming up, we get back to the geopolitics. Russia strikes Ukraine grain exporting ports ahead of a Putin-Erdogan talk. We're going to have more on that next. This is Bloomberg. Welcome back to Bloomberg Markets on this Labor Day holiday. So volumes are lighter, but European risk assets are doing well. Shares of the European stock 600 companies up about 0.5%. Two-year yields, those move higher in Germany after falling thanks to expectations that perhaps Europe will face a stagflationary environment. Morgan Stanley on Friday said that the ECB was done, finito with hiking rates. But not exactly what we're trading today, but perhaps just a breather from that. Meanwhile, NYMEX crude stays steady with oil trading just around a November high. All right, turning to geopolitics, Turkish President Erdogan has been urging Russia to return to a deal allowing Ukraine to export grain. But a barrage of Russian drone strikes on Ukrainian port facilities has set a somber tone just before the talks. Bloomberg's Maria Tadeo, Bloomberg correspondent of Europe, joins us now for more. Maria, look, a lot of ground to cover here when it comes to latest developments in Ukraine. Can we just start with this? The grain deal, the talks between Putin and Erdogan. What exactly is expected?
Yes, Dani, and the meeting now is going on, is underway, I should say, in Sochi. This is in Russia. Remember, there was speculation for a while as to whether Vladimir Putin would go to Turkey or Erdogan would go to Russia. We see now that it's Erdogan that's made the move to go and see Vladimir Putin in person. Now, again, the focus of this meeting is, in most terms, I would say, we have now lines from Vladimir Putin. So, as I say, this is underway. But the goal of this meeting is to reinstate this grain deal that Russia pulled out from a month ago unilaterally. Remember, this is a grain deal that facilitates the shipments and the exports of food out of the Black Sea. This was a grain deal that was negotiated and mediated by both the United Nations and Erdogan. The Turkish president has made it clear he wants to see it reinstated as soon as possible. We do have, as I say, some new lines from Vladimir Putin, who is meeting Erdogan in Sochi today. He says he could debate, he could talk about it. He's open to talking about this reinstatement of this deal. But again, to me, I don't see anything specific that would point that this grain deal would be resuscitated anytime soon. But as I say, there's a lot of pressure in terms of facilitating the exports out of the Black Sea. At this point, as you know, Dani, we've seen tensions going crescendo over the past few weeks, because remember, when pulling out, Russia also said that it would treat ships as potential military targets and potential military cargo, so that no longer guarantees the safety of ships. The same goes for Ukraine, which retaliated in the same way.
And at the other side of things for Ukraine, there's been a shakeup that you've been reporting on when it comes to defense leaders and advisors. What exactly is happening there, Maria?
Yeah, so this is the defense minister who's been now, dismissed by President Zelensky. He's also tendered his resignation. This goes again into allegations, and I should be careful to stress this here, not personal allegations about corruption, but the idea that the ministry mishandled or may have mishandled and inflated contracts when it comes to things like food, but also uniforms for soldiers. Now, he has resigned, as I say, from the ministry. He has been replaced, and today I spoke with one of the top advisors to President Zelensky, Ihor Shofkwa, and I asked him, what does it mean specifically for the counteroffensive, if anything? Let's take a look.
Minister Reznikov has done a very good job for a lot more than 500 days of the wartime. You see that Ukraine is now gaining the arms, it's gaining the support, it's gaining the ammunition. This was not happening, unfortunately, before the open aggression of Ukraine, and immediately after the open aggression of Russia to Ukraine. Only after several months, we started to receive in numerous amounts this what we are hearing now, and that's what allows us to have made already several major counteroffensives, and now, we are having another very important counteroffensive, which is going on as it goes on. I mean, this is not a Hollywood movie. You cannot do it within one day, but very important. This is going on. So the president is making his decision. He has absolutely right. He's chief military commander of the country. So we are hoping that the tempo of the counteroffensive will be increasing, and definitely Ukraine needs to achieve very significant results in the near soon.
And Mr. Shofko, just to end on this subject, of course, a counteroffensive, the defense ministry is important for a lot of the contracts and supplies, but it really is the generals that handle the operation on the front line. Is this going to have any impact on the counteroffensive, do you believe? And I wonder, too, your foreign minister, Mr. Kuleba, last week, he was very open about what he believes is too much criticism, everyday commentary, and how this counteroffensive is going on. And he said, again, it doesn't play on Twitter time, it's happening in real life, and critics will be proven wrong. Do you feel perhaps there's too much negativity about this counteroffensive?
Well, again, like you said in the beginning, I'm not directly involved in the planning of the counteroffensive. That's up to the military people and the generals you mentioned. I don't think there will be any significant changes in the relations on the military field, on the military field amongst the military commandment. Criticism is always at place. Ukraine is a democratic country, and you're a journalist yourself. You know how journalists like to go into any single detail to criticize sometimes for the slow pace, sometimes that something is not happening. Let's leave the pieces and the particularity of the counteroffensive to the people, to the professionals. When the result will be in place, and the result will be definitely in place, we will be first to see and command and to commemorate the victory of Ukraine.
And Mr. Shevko, also going on this week, equally important is the Green Deal back at focus. Remember, you had agreed to this Green Deal with the United Nations. Turkey was also involved, and then Russia pulled out of it unilaterally a month ago. That deal now, for the time being, has been, broken. The hope is for it to be reinstated. I wonder, do you have hopes that President Erdogan can reinstate this deal? Have you had any talks with the Turkish delegations? Because they're the ones that are going to Russia with a message for Vladimir Putin, which is, again, to reinstate the deal.
Like you rightfully said, Ukraine has not withdrawn itself from the deal we are having with Turkey and United Nations. And that's why we continue, we are trying to continue the existence of the grain deal. We are working on the alternative routes. And you might have seen in the news already that several vessels are already using this alternative route to further export Ukrainian agriculture products. At the same time, yes, we know about today's meeting, and several representatives of Turkey were in Kyiv a week before that, including the foreign minister, Hakan Fidan, who knows absolutely well the position of Ukraine. And yes, definitely, we count on the Turkey's position to support this grain deal. It is not only for Ukraine to have this grain deal. It is only for also for the poorest country of Africa and Asia. We were exporting throughout the last year more than 30 million tons to these countries, and we are ready to do this. Again, the crops in Ukraine this year is quite good, so we are ready. We are ready to be a world's breadbasket. Even in terms of war, Ukraine is suffering from Russian aggression, and the world is suffering when Russia uses aggressive instruments in the food security area.
So just very briefly, you trust that the Turkish delegation can get to a breakthrough. That is your expectation based on your conversations with them.
We trust that Turkey will do everything possible and impossible on this regard.
Well, thanks for that. And that takes me now to the second part of this Green Deal, because as you know, Mr. Shevko, you're also exporting, or we're exporting to a number of European countries. Then there was a restriction on the number of exports that you can get. This was led by a coalition of European Union countries, including Poland. Now, do you believe those restrictions will be extended over time? That would be detrimental to you. Are you having any conversations with the European Union about not extending it? What sense do you get, especially from the Polish, on this?
That's unfortunate development of events, right? You are our nearest partners, including Poland, were introducing these unilateral restrictions over Ukraine's trade. You remember several months ago. Now we have the decision, the resolution of the European Commission, which has to cease its existence exactly on the 15th of September this year. And we hear the position of President Ursula von der Leyen, which she communicated several times to my president, that after this period, these European Commission restrictions will not exist. We have to save the principles of free trade. Ukraine and the EU has the association agreement, and part of this association agreement and deep and comprehensive free trade area between Ukraine and European Union. So that's important to stick to the rule of the European Union. It's important to stick to the association agreement. Ukraine, again, in times of war, is producing and exporting and transiting its products. And we should live in the free market economy. This is the principle of the European Union.
President Zelensky's advisor there speaking to Bloomberg's Maria Tadeo. Coming up, we're going to turn to this stock market with Sophie Lund-Yates, equity analyst at Hargreaves Lansdown. Is this a complacent market, or do you want to chase a rally? All that coming up. This is Bloomberg. Welcome to Bloomberg Markets. From London, I'm Dani Burger. Stocks around the world gaining ground on the heels of another round of support measures for China's beleaguered property sector. U.S. markets are closed for the Labor Day holiday. Plus, a major meeting in Sochi. Turkey's president hopes to convince Russia's Vladimir Putin to revive a Black Sea grain deal ahead of a G20 summit later this week. And top automakers from around the world gather in Munich for Germany's International Motor Show. We'll bring you the highlights coming up. So it was a good handoff from Asia. The Hong Kong stock market really taking off. Of course, it was closed on Friday. More hopes that the stimulative measures from China are actually having an impact. Here's the result of that. European equities up 0.5%, euro stronger versus dollar, and two-year yields in Germany undoing some of the fall that we saw. NYMEX crude little change after hitting 8 November highs. So there you go. Stocks continuing to march higher. The MSCI World Index is now up 15% year to date. Such investor confidence, though, could be a warning sign. That's according to JP Morgan's Mislav Matecha. Here's what he wrote. There is complacency in sentiment evident. The VIX is near record low and positioning has increased. There's no more safety net. FOMO is in full swing. There is no cushion anymore as investor sentiment is now fully signed up to a soft landing. Joining us now to discuss is Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sophie, so great to see you. Great to have you in the studio. What do you make of that call? Would you agree with JP Morgan that we're a little too complacent right now about a soft landing?
Firstly, thanks for having me. Great to be here. Fundamentally, yes, I do. I think complacency really is a really good way to put this. You know, when we look at, for example, what the Nasdaq has done, you know, that's 35% up year to date. We look at the way consumers are behaving and thinking as well, the way that that's kind of been surveyed about how people are thinking. This is not a market that is pricing in any kind of wiggle room as well for some kind of potentially rougher landing. And I do think that's still feasible. When we look at the extent of rate rises, I know obviously this has been talked about so much, but actually you look at the rate of cooling that is happening, I do think there's a possibility here that there is quite a significant disconnect between what markets are expecting and what might be happening. I do think complacency is, as I say, a good way to phrase this.
Yeah, Sophie, I got to tell you, honestly, whenever when I talk with my producers and we say, who do we want to bring on about tech, it's always you. Can you translate this into what it means for tech? I mean, are there any pockets that are still safe in a hard landing scenario, or just across the board, are valuations too high to justify what they should look like during an economic downturn?
Yeah, look, I'm always at risk of slightly contradicting myself here when I'm asked around this subject. You know, we have this incredible mega trend going on. You know what I'm going to say, and it is AI. Yeah. And I do think there are some incredible names in this space, particularly on the chip side. And I'm not just talking about NVIDIA. You know, I think that actually some of its downtrodden rivals are actually peddling quite hard to take some share potentially. I think actually from maybe more of a value option, there's potentially some room to grow there. But look, fundamentally, valuations are looking incredibly full, and we know what that means, right? You know, price is what you pay, value is what you get. And I do think that the risk of some bounciness, or you might want to call it volatility, I do think there is risk of that coming through, particularly in some of the more peripheral names in the tech space. But yes, certainly opportunity there. Of course, there is this trend is enormous, but yes, certainly I do think some risk too.
Right. Can you kind of break down for me, an absolute amateur in trying to understanding tech, because I look at Broadcom earnings, for example. AI was fine, but it wasn't enough to make up for some of the downturn. Are we in this world that if you're broad, I guess, horrible pun, but it's all I got, broad like Broadcom, that you're not going to survive? You have to be a more concentrated type chip maker?
Yeah, I don't know if it's necessarily about survival versus not survival, but in terms of thriving, absolutely, I do think that we're seeing Intel, for example, which is very much more on kind of the hardware focus, and that's where chips are slightly more, the environment is more challenging. You know, we're seeing expenditure there trimming down. You know, consumers aren't buying on big ticket items, and they're more exposed in that area. So if you're more exposed to hardware than you are AI, it absolutely makes sense to be trying to move over into that techier sphere if you want to thrive over the medium term. I would say absolutely.
So Sophie, there's a decent amount of risk appetite in today's market, just based off of China. That, you know, there's been a lot of home buying. Finally, perhaps some of the measures they've done around property are starting to take effect. Have there been enough measures at this point in your mind to translate into strength in Europe? Is it enough to come into this region?
I knew this question was coming. It's such a huge one, right? Fundamentally, the amount of stimulus that we've seen, coming for China, obviously, it's huge, and it is having a bit of an effect. But I actually think that the Chinese economy needs even more of a shove than what we've seen so far, particularly before I'm in a position to say that I'm comfortable that the demand and the growth profile and how that feeds across to Europe, particularly when you look at names like luxury. I don't think we're there yet. It is concerning. You look at the creaking property market, the unemployment situation in China. This does matter for Europe, and I'm not certainly looking at this, and I don't feel completely comfortable just yet that Europe is going to be completely cushioned from that. More stimulus could and should come, in my opinion.
How willing are you to bet that it will come, I guess, is the question, because we've been looking for the shock and awe sort of stimulus. We've gotten a lot, but not that, not money directly into consumers' hands.
No, absolutely. And I think really one thing to point out is that China has a lot more levers to pull at its disposal economically. So I do think there is more to come through. The big question, of course, is whether or not it will be deep enough and strong enough to actually have the desired effect, because we're not there yet, even though we are seeing some benefits trickle through.
It's interesting, this idea of perhaps some of that needing to support luxury stocks. I saw this research note from BCA that, I have to be honest, I actually thought of you when I saw it, because it said that if you want to look for the best growth stocks, a thing that basically has a moat around its, prices, around its margin, it's French luxury, it's not tech. Basically them saying it's luxury over tech. What do you think of that sort of idea, that is the power players, not the U.S. mega cap tech?
That is certainly a huge call, but I can understand absolutely where they're coming from. The level of resilience on spend when it comes to luxury, I do think is more cushioned, it's more protected than some corners of tech. Absolutely. You might see advertising spend trimmed in the face of a hard landing, or when people start to get scared of recession, that hurts tech. But your core demographic for luxury players, they're not as put off by inflation and recession as maybe the customers that are relying on tech are. So I do completely understand where that's coming from, and I do continue to think there's a lot of strength in luxury. But of course, it comes back to that huge valuation question, and some of those valuations in particular, you are really paying for that strength, I would say.
Do you think in this earnings season, now that it's done, say for the random UBS delaying earnings, did you learn anything about corporate Europe that you hadn't thought of before going into the season?
I think for me, what's really stood out, and this just makes me sound like a negative person, I was expecting the picture to be a lot more grey, a lot more difficult than it has been. Margins are holding up, or at least the outlook for margins is not as bad as I was expecting, and particularly when you look at consumer discretionary spend. I mean, that's a whole other conversation. I could spend all day on that. Consumer discretionary is certainly in a much better spot than I thought it was going to be. So that's been a nice surprise, and how long it will last, again, is the core thing to watch for me from here.
Yeah, Sophie, I can say with absolute confidence, we've been talking for over the years, you're not a negative person, you're a realist. I can say that with a lot of confidence. Look, unfortunately, we don't have time to get into too much of the consumer conversation, but I do just wonder what that means for all these stagflationary expectations for Europe. If we still do have a strong consumer, I mean, is there really going to be no growth? Is that lending itself to more stagflation?
Potentially, yeah, and this is the problem, right? The ECB is really, I describe it as a knife edge. It's really got a really narrow channel here of either allowing inflation to become entrenched at this kind of 5%-ish mark, or triggering recession. And as you're saying, that policymakers are looking at this and saying, well, the consumer backdrop is, they're not behaving in a way that would suggest recession is coming. And that does, to me, say that further heat needs to come out of the economy, and those rates are going to have to rise again if we're going to get things moving in the right direction. And time will tell.
Yeah. Sophie, thank you so much for joining. Really great to see you. That's Sophie Lund-Yates of Hargreaves Lansdown. All right, let's turn from equities to the broader market story. Joining us now is Bloomberg's Noor Al-Ali. Noor, look, I wanted to start on oil. It's kind of a bummer. It's not really doing that much at the moment. WTI and Brent are maybe slightly down, but honestly unchanged. But we were looking at November highs. What's driving this market? Is this all OPEC plus cuts getting priced in here?
There's a lot of optimism in the market currently in oil. We've seen this narrative, time and time again this year. A big factor, as you say, is those OPEC cuts. Also, reminder, we've got the APEC conference in Singapore, a lot of bullish players on the ground talking to each other, and that really adds to that sentiment, that vigorous, feel that you'll get in oil markets. But also, don't forget the physical markets as well. We're talking about the oil market structure, time spreads, really pointing to strength in this rally again. again, we've seen the June rally fizzle out, but now we've seen that kind of being reignited. And now Brent, WTI really making their sights on towards the, the highs that they haven't seen since November. We're talking above $90 per barrel for Brent. And we're seeing that in spreads really turning more further and steeper into backwardation, which is a bullish market structure across different time spreads, whether the prompt or the other ones. And I think, this could potentially point to that rally really having its momentum and strength to go further.
Is anyone talking about inflation reaccelerating off the back of this yet, Nor? Because it's not just oil. There's also fears that European energy will pick up again with potential strikes in some LNG terminals in Australia. Is that a concern yet for this market?
Absolutely, right? I mean, we've been talking about, me, my colleagues at the MLive blog consistently about how inflation could potentially resurge now towards the end of third quarter and the fourth quarter. And that's something that's potentially on the minds of central bankers. Jackson Hall, I'll take you back there, central bank governors and policymakers kept telling us, we're on a data by data approach. We're going to take it on a meeting approach. We're really going to look and parse into that data. We know that the Beige Book is coming out of the Fed this week. Christine Lagarde also speaking later today. All these concerns point to the fact that, these central banks could potentially not be done, in their restrictive cycles, right? So we are talking about them ending raising rates potentially very soon, maybe one more hike priced in for the Fed and the ECB. Obviously, the UK is a completely different story. But at the same time, you still have that risk of inflation resurging and being a lot stickier away from target. And reminder, the ECB, the Fed, the BOE have that 2% inflation target. Real policy rates is not restrictive enough for the ECB or the UK to really consider, for them to sort of loosen the shackles of tightening just yet. So we might be seeing a scenario where interest rates continue to be restrictive for longer. So we're no longer talking about higher for longer, as in more cuts to come, more interest rates to come, but we are saying, okay, we're going to stay in restrictive territory for as long as it needs for those central banks to reach their target.
But Nor, that's not stopping the curve steepener fans from putting on those trades in the U.S., is it?
Yeah, absolutely, right? Because you can't trade against the momentum. And this has been a dominant theme throughout the summer. Now, kids are going back to school in the UK. There's a lot of talk now about this soft landing narrative. And you mentioned it earlier, the JPM conviction that perhaps there's a lot of complacency in the market here. We are seeing that there's a lot of bids and calls now, for the 2-year, it's now is the time to buy. And I can see that, you can see the labor market in the US, particularly, showing these signs, particularly in the wages aspect that the Fed has been looking for. And so that really points to, potentially a pause in September, or, a pause and then a hike in November. And it really depends on the data. Again, I can come today and tell you, yes, this is the time, but then next week, inflation, core CPI, shows something completely different, and that puts the hawks back in charge. And it really does depend on that data, especially after the summer surge and that sort of seasonal data wears off.
Yeah, and I believe the Fed blackout period starts on Saturday, so it's not like they can come in. I mean, maybe they can talk to some of their friends in the print media, but they can't exactly come in outright and try to nudge this market in any direction. Hey, Nor, thank you so much. Bloomberg's Nor Al-Ali there. All right, coming up, we're going to talk about China's President Xi planning to skip the G20 meeting in India, sends Premier Li Keqiang instead. This is Bloomberg. Welcome back to Bloomberg Markets. European equities pushing higher alongside the euro as yields do start to go higher in Germany after a fall on Friday over fears of stagflation. So world leaders, economists, and CEOs gathering over the weekend at the annual Ambrosetti Forum in Cernobbio, Italy. Bloomberg's Francie Lacqua sat down with Nobel laureate Joseph Stiglitz and asked about the current state of China's economic tensions.
China has sometimes been analogized to riding a bicycle. If you're going at 7%, everything is going well. Very hard to ride a bicycle at a very slow speed. And for 40 years, they the mentality has been a high-speed system. So when you have a high-speed system, you build property well in advance of what you need. You make mistakes. 6 months later, a year later, those mistakes are corrected because there's so much demand. Now they have to do a better job of fine-tuning, and I think their system is not well adapted to doing that, particularly under President Xi, who has dismissed a large fraction of his economic experts.
But Professor, so is this first of all a political decision, right? So he wanted to consolidate power, and he could only do that possibly if the economy was strong. So does he change now that he has more control, or do you think he's weakened because of a weaker economy?
I think he's surely weakened, but that doesn't say how he will respond. When you feel things are not going your way, you may respond in a more, quote, stronger way that may actually be adverse to the real performance of the economy. Steering an economy of the size of China is not easy. China, in what we call PPP, purchasing power parity, a way of trying to equivalize different economies, is larger than the United States. No one would even conceive of trying to steer this monster, but China, President Xi thinks he can do that kind of steering. And, I'm suspect. Yeah,
but by saying you're suspect, then are you expecting a lot of, concern, a lot of volatility with China? And what does that mean for the rest of the world?
Well, I'm expecting, and I have been expecting exactly what we've been seeing, that they they tried this, it doesn't work, they do a little bit too much of that, and then they get worried, and then they go back to this, they shut down part of the tech sector. There's it's not just what we're talking about here, it's not just the property sector, which is a very large part of the economy, but it's many other sectors of the economy.
But Professor, is the only way then to slow the economy, right, to be able to readjust? And what are the impacts for the US, the Fed, and Europe?
Well, I think we have to remember that in the 2008 economic downturn, China was the source of engine for the global recovery. It was pivotal. It won't be there. And in fact, I worry it will be dragging down the global economy. And that's one of the reasons that I'm so concerned about what has been going on in monetary authorities, particularly in the United States, that they've pretended that nothing's going on in the rest of the world. They've been raising interest rates well beyond anything that is reasonable, and have put at peril, particularly, I think, the European economy. I think America is going to do okay, but I worry about Europe.
And what a great metaphor there. It's hard to ride a bike that's going slow. That was Nobel laureate Joseph Stiglitz alongside Bloomberg's Francine Lacqua at the annual Ambrosetti Forum in Cernobbio, Italy. I should say that conversation happened on Friday. Since then, we got data over the weekend that existing home sales for Beijing and Shanghai doubled over the weekend versus the previous one, according to CIMB. So there is hope that perhaps, at least on the property front, some of the stimulus is having an impact. Now, sticking with China, President Xi Jinping is planning to skip the G20 summit this weekend, sending Premier Li Keqiang instead. This is happening amid already simmering tensions with host country India. Joining us now for more on this is Bloomberg's Rosalind Matheson. Roz, let's just start with why Xi might skip this G20. I know we don't know for certain, but what is some of the thinking as to why?
Well, there's a number of potential reasons, and perhaps there's more than one in play in his thinking. on this. The first one, of course, is that things are in a particularly uptick in the tensions that we've seen for years between China and India over trade, over technology, over border disputes. That all seems to be flaring again in this minute. Perhaps Xi Jinping doesn't feel he wants to be appearing too much at Modi's big show in India this weekend. There's also the reality of what you were just talking about, which is the turbulence we're seeing in the Chinese economy. Really lots of signs of strain there and big questions about how they get on top of it. Perhaps he's really signaling that he wants to stay home and focus on that and send that message domestically also to the people of China that this is priority number one for him right now. So that's also potentially a factor. And then, of course, there's the sort of the push to create these alternate power groups from Xi Jinping and others and move away from these sort of Western-led institutions that they see as the G7, the G20, and so on, and create their own power blocks. And he recently did attend the BRICS summit in South Africa, which is sort of Brazil, Russia, India, South Africa, and China. And they're seeking to expand that by bringing in a bunch of other countries, including Saudi Arabia. So perhaps he wants to prioritize his own outfits versus attending another G20.
What does this mean, though, for Prime Minister Modi as a host of this to not have Xi come?
Well, certainly it makes it a lot harder for him as the host. Russian President Vladimir Putin is also not going in person, but probably will dial in to at least some of the meeting. And having China send the premier instead of the president is really a complicating thing for Modi and makes it harder potentially to get a communique, because you can imagine that on the India side now that the conversations with China at the meeting are going to be quite fraught. So can they even get an end of meeting statement from this G20? That's got to be a source of pride, of course, for the India group to get that. So that's a big question mark. Can you get fruitful conversations about some of the key things at hand? Obviously, the continued fallout globally from Russia's invasion of Ukraine, for example, the state of the global economy. Can you get coherent policy responses from the group to that? So for Modi, sort of a national pride as the host thing is a real challenge here now. Can he get everybody in the room to agree? Can he get a communique?
In about a little over 2 months' time, Roz, APEC, the Asia-Pacific Economic Cooperation, is set to meet in San Francisco in the U.S. Does this also throw into question as to whether Xi will attend that? And what does that mean for any potential Biden-Xi meeting?
Well, that is really the key question from here. If he skips this meeting, is he going to show up at APEC? Of course, he probably has a stronger incentive to attend that meeting. There's been those gradual signs that China and the US are moving towards having a proper sit-down meeting between Presidents Joe Biden and Xi Jinping. And that could take place at that APEC gathering on US soil. And for Xi, it's also a prestige thing, being invited onto US soil, being hosted by Joe Biden, being seen sort of as a great visiting leader. That's important for him, for his domestic messaging. And they've got a lot to talk about, a lot to sort out when it comes to the state of the global economy. We've seen certain signs that they do want to put that relationship on a more even keel. So at this point, he's probably got a greater rationale for showing at APEC and skipping the G20, but we won't know for sure potentially till just beforehand.
All right. So, again, 2 months, I guess, to wait for that. Roz, thank you very much. Rosalind Matheson there on the latest with China and G20. All right, as we head to the break, European stocks moving higher, just under 460 on this Euro Stock 600. Euro now below 108. Now, still ahead, Italy, it may accelerate its sale of its stake in Montepaschi to boost public finances amid slowing growth. Italy also talking about selling more stakes in state-owned companies. We're going to bring you our interview of Italy's Deputy Prime Minister Antonio Tajani on this side of Lake Como. This is Bloomberg. Welcome back to Bloomberg Markets. A nice risk-on type of day, probably unfortunate for those in the U.S. who are offline. Of course, cash trading is not happening in the U.S. either in treasuries or in stocks. Futures are still trading. You are looking at a NASDAQ rally up 0.25%. Russell 2000 futures, those are trading lower. However, in Europe, it's thanks to China stimulus that we are looking at 460 on the Europe Stock 600. That's up 0.4%. Euro, that's struggling to hold on to 108, trading just below it after weakening versus the dollar on Friday. A Goldilocks jobs report in many estimations, helping to support the dollar. Meanwhile, German two-year yields, we have been moving ever since comments from Schnabel, some weaker economic data, moving to price out an interest rate hike. Meanwhile, NYMEX crude off the back of a tighter market, thanks to OPEC plus cuts, trades at just above $85.50 a barrel, trading just around a November high. Does that re-accelerate concerns about inflation, energy-based inflation, just as we are getting more confident, at least in the U.S., that perhaps the worst is over, perhaps the Fed can put things on autopilot. Perhaps they can end the rate hike cycle now. Now, sticking with the European story, in Italy, the government is considering to accelerate the sale of its stake in Monte dei Paschi in an effort to boost public finances as the country faces worse than expected economic growth. Bloomberg's Francine Lacqua spoke to Deputy Prime Minister Antonio Tajani at the Ambrosetti Forum.
My party is in favor of the privatization, not only the Monte Paschi Bank, is for have more money for the state in our budget. We need to work in this direction. The debate is open. We need to decide in which sector we need to achieve these results.
So which ones are you looking at? Monte Paschi and what else?
There are a lot of state building, former barrack. It's possible to work in this construction sector and for having more money, but we need to decide also the services. My idea, the idea of my party is to privatize the services in the ports, for example, but also to privatize the services in the local level.
Minister, when you say that you want to accelerate the sale of Monte Paschi, how quickly could that happen?
We will decide, I think, in short term on this. This is a job of the Minister for Economy. He will propose, I think, in short term, 2 or 3 ideas, and we will decide in short term. I think we need to do it because for me, we need less state and more companies in the economy. I am liberal. For me, it's crucial. Also for attracting new investment from abroad, we need to organize a revolution for the liberalization, reform on fiscal reform, on justice reform, civil justice reform, less bureaucracy, less bureaucracy, because there are a lot of money, also Italian money in the banks. If we want to involve the private sector, we need to organize this revolution in favor of reforms.
Italy's Deputy Prime Minister Antonio Tajani speaking with Bloomberg's Francine Lacqua at the annual Ambrosetti Forum in Cernobbio, Italy. Staying with Europe, joining us now is Christian Schulz, Deputy Chief European Economist at Citi. Christian, great to have you on. Look, at the moment, we've got about less than 30% odds priced into the market that the ECB moves in September. Morgan Stanley on Friday just changed their call, saying that they think the ECB is done. Do Morgan Stanley, do they have it right?
It's definitely a very finely balanced decision. Over the past week, and our base case has been for a while that they'll hike 25 basis points again in September as a last hike. 2 weeks ago, I would have said, I don't think they're going to hike. I think they're done. It screams not to hike after PMIs at such weak levels. After last week, I'm less sure. In fact, I'm a bit more convinced again that they'll hike by 25 basis points. The inflation data was relatively strong. We had what I think was a fairly hawkish speech, actually, by Isabel Schnabel, which the market saw established. And we had more coming up, for instance, Pierre Wunsch saying that they want to hike by 25 basis points. So I think there's quite a few arguments also in the composition of the council next week that make us stick with our call that they're going to hike 25 basis points next week.
Let's go back to Schnabel. Christian, I asked you if you had any controversial calls in the break. This is kind of one because the markets took Schnabel's speech and really ran with it, saying that the economy was looking weaker than some of the forecasts, some of the expectations. That's really what the market globbed onto. What should we have been paying attention to in that speech?
I think what people should have been paying attention to is why growth is slowing. Yes, she acknowledged that growth is slowing. Yes, she said that there could be a pause in September. But the reason why she thinks growth is slowing is essentially that the potential of the euro area economy has been diminished. And if the potential is diminished, then essentially the speed limit of the economy has gone down to a degree where the economy perhaps can't even grow at all and yet still produce inflation, and the ECB has to hike interest rate. What I think she's been making very clear is that if inflation doesn't come back down to target within reasonable, forecasting horizon, and that forecasting horizon is the same as in the ECB staff projections, presumably until 2025, then the policy isn't restrictive enough, and we don't see the ECB revising down the inflation forecasts for 2025 below 2% next week. And if they don't, well, then the Council is going to conclude that policy isn't restrictive enough and is going to deliver yet another 25 basis point rate hike.
In this idea that the potential of Europe and its economy to grow is diminished, I want to take that out beyond current expectations, beyond 2025. We talk a lot about getting inflation back down, a trough in growth potentially. What happens after that trough? Is it possible for Europe to get back up and running if things like, for example, the cheap energy model of Germany are no longer available to this European economy?
But those are exactly the structural issues that the economy is facing. These series of energy shocks, the shift from cheap pipeline gas to much more expensive LNG, for instance, which is likely to be permanent. That's the sort of stuff that's the sort of developments that reduce potential growth. Also, of course, the demographic changes in labor market, changes in immigration, the competition that important industries in Europe are facing from China because China itself isn't growing fast enough anymore. All these factors say the economy isn't going to accelerate, it just can't grow any faster. And if it can't grow any faster, then it's going to produce inflation even if it doesn't grow. Potentially. Also, of course, labor markets are very tight. Of course, it could also just be cyclical. It could just be that it takes time for the energy shocks from last year to dissipate, that demand is eventually going to come. It could also be that what's going on at the moment is simply the reflection of very tight monetary policy and that the ECB has simply gone too far already, in which case we'll fall into a recession and inflation is going to come down like a rock. Unfortunately, inflation isn't going to come down very fast either way. And therefore, I think the ECB will be in this risk management process of still hiking at least once in September.
Does that also mean if there's more of a structural element to it, the transmission mechanism of the ECB is different? Is that also a right interpretation of what you're talking about, Christian?
There's great uncertainty about the transmission channel. We haven't had a rate cycle, certainly of this order of magnitude, for an extremely long period of time. And clearly the economy has changed over that period of time. We do see transmission in anything related to the housing markets. I think one of the reasons why Northern Europe has much weaker economic confidence at the moment than Southern Europe isn't to do with energy or manufacturing weakness, but is actually the housing markets in the north were just simply more overheated. Northern Europe has binged more on high interest rates, if you like, than Southern Europe this time around. So monetary policy is clearly working. It may still be working more next year, in which case we get a recession next year, but it may already be working quite a lot, and that would say the ECB should be done. It should stop. But we don't think the ECB is going to come to that conclusion.
All right, Christian, appreciate your time this morning. Citi's Christian Schultz, maybe with some polite disagreement there of Morgan Stanley's call. All right, economists and CEOs gathered over the weekend at the annual Ambrosetti Forum in Cernobbio, Italy. It's not just politicians. Bloomberg's Francine Lacqua sat down with Nouriel Roubini, chair and CEO of Roubini Macro Associates, and asked if he sees a chance of a global recession.
Compared to 6 months ago, where there was a serious risk of a real hard landing for the global economy, those risks are reduced right now.
No.
That's the good news. But I think that there's still an open discussion on whether the global economy is going to achieve a soft landing as opposed to a bumpy landing, where a bumpy landing will be a short and shallow recession. That short and shallow recession has already started in the Eurozone. The UK, with very high inflation, is probably headed towards that recession as well. In China, there is a sharp slowdown of growth. It's not just cyclical, it's more structural. United States, still the jury's out on whether we'll achieve a soft landing or whether there's going to be a short and shallow recession. So it's a mixed bag.
But that depends on what? So in the US, is it Fed policy or is it just the tight labor market that could suddenly collapse?
Well, in the US, paradoxically, so far, in spite of the Fed hiking rates above 5%, the economy has grown recently above potential. Tight labor market, tight goods market. That's good news in terms of achieving a soft landing, but it's actually bad news for the Fed because it implies that the Fed is not done yet. They may have to hike once more, maybe twice more. Eventually, the Fed funds rate might have a 6 handle rather than a 5 one. And the more that happens, the more the risk that eventually there might be at least a short and shallow recession. But the economic data recently have been reasonably strong, even if it's slowing.
What do you make of China right now, and what are markets most misunderstanding about the world economy and actually how equities and bonds should behave?
Well, China, the reduction in growth is not cyclical, it's structural. It has to do with aging of population, debt and leverage, housing overhang, state capitalism, a backlash against the private sector that depresses the sentiment of household and the corporate, geopolitical depression, the policies that are effectively Marxist-Leninist of Xi Jinping and so on. So I think that potential growth used to be 10, went to 5. I think it's at best 3 to 4%, and that's not going to change because it's emphasizing security control over opening up and reform. That's the main thing. Yep. I would say on markets, in my view, if the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing, probably markets have rallied too much today. And that's maybe going to lead to a correction in the second half of the year. If the economic data are still weak and if central banks have to hike a little bit more as a way of essentially fighting inflation, and that's going to lead to a nominal and real rates rising as well. And that means that probably bond yields may go higher rather than lower while inflation is still high and central banks are still fighting inflation.
But a correction, what, a 10% correction in equity markets, or is that too high?
Well, a 10% correction is not totally unlikely. If the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more, I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
So what would you do if you were Bank of England governor?
Well, Bank of England is facing a dilemma. On one side, growth is lower, and is lower also because of a self-inflicted goal that was the Brexit decision by the UK to reduce potential growth and increase cost of production. So it's the most likely case of stagflation. On one side, the economy is headed towards a sharp slowdown, potential recession. On the other side, core inflation is still too high, and therefore you face a dilemma, or a trilemma in the case of the Bank of England, because you want to have lower inflation, but that's going to cause a recession, and higher interest rates are going to imply eventually financial instability, because private and public debts are high, and debt servicing ratio are going to rise as interest rates go higher. So you might have actually a perfect storm in the case of the UK.
Is there anything that actually fiscal policy or just government policy can do to try and mitigate that?
Well, fiscal policies are also in a dilemma, because if you want to maintain growth, you should have expansionary fiscal policy, but now fiscal policy at cross purposes with monetary policy. If you have too much essential inflation, it's because there was too much demand. That implies that cyclically, structurally, fiscal policy should be retrenching. The opposite is happening, and that's make the goal of central banks of achieving price stability harder rather than easier.
Nouriel Roubini speaking exclusively to Bloomberg's Francine Lacqua at the Ambrosetti Forum. Coming up, we're going to be going live back to the IAA Auto Show in Munich. We'll be speaking with Bloomberg's Oliver Crook, who also has a guest on the EV race. All of that coming up. This is Bloomberg. Welcome back to Bloomberg Markets. Two-year yields in Germany still hovering around 3%. It is this push and pull. What are you more worried about? Is it economic growth in Europe or is it inflation? 10796, let's call it, is where the euro dollar trades. Meanwhile, European stocks just under 460, up by a third of 1%, buoyed by some China stimulus measures actually having an effect. Meanwhile, NYMEX crude slightly lower, but around a November high. All right, let's get back to the cars, to the auto conversation. Bloomberg's Oliver Crook is at the Munich Auto Show, where EVs are in focus. He's there with a guest. Oliver.
Hey, Dani. Yeah, we're here in Munich at the Battle of the BEVs, and here we're joined by the CEO of Zeekr Europe here, this is the EV arm of Geely. You're now approaching the European markets. The cars haven't quite hit the roads yet. They're literally on their way to Europe. Talk to me about the expansion plans here in Europe.
Yeah, so we're, as you said, we're just entering the European market. We're launching our first two countries this year, which are the Netherlands and Sweden, which are also our home bases in Europe, because we design and engineer. A large part of the engineering is done in Gothenburg and Amsterdam, which is the business home of the brand. So these are our first two markets. We'll be delivering cars in both of those markets this year. We've already announced today the launching of pre-orders in Germany. And for next year, we're preparing, of course, Germany, Norway, Denmark, and France as our next wave of markets to go live.
And how are you seeing demand hold up here? How much interest is there in the EVs? You obviously chosen Europe and those markets for a reason.
Yeah, I mean, the interest is amazing because a lot of European consumers who are saying, my next car will be an EV, are struggling to find the solution within their historical brands. So the shopping list has completely blown wide open, and they're considering brands right now, a much wider range of brands that they ever have before. They're curious, they're looking at all of these newcomers and saying, hey, what's really there? So I think if you can get the value proposition right for that consumer, there's a huge opportunity.
And on that value proposition, what are you looking at in terms of pricing for the European market?
So pricing for the European market for this type of premium vehicle is actually quite competitive. If we look at the 001, which is behind me, starting from about 59,000 euros for a long-range rear-wheel drive version, 620 kilometers of range, and going up to 69,000 for an all-wheel drive, 580 kilometers, 0 to 100 in 3.8 seconds. So quite competitive product, and at this price point, really, really hard to beat.
So you spent 24 years at Toyota, and very famously, the Japanese and Korean car makers took a very long time to break into the European market. How do you avoid that from happening again from a brand coming from the outside?
Well, I think the great opportunity that we have is that the market is shifting right into where our core strengths are. And if you look at the two fundamental axes of that shift, the first is the advancement of software and software-led kind of interactions from a consumer perspective, and the second is electrification. And on both of those fronts, I think we have a competitive advantage that allows us to structure a great value proposition for the customer today, but also something that can continue to evolve in the coming years.
And you're doing this, though, with the backdrop of a sort of price war being raged in sort of full force over in China. You yourselves have cut prices to really stay competitive, get that volume up. You see that spilling over into Europe?
I mean, you know, obviously Europe is going to be a little bit more complicated because of the impact that other factors have in in defining your price point. The other thing that's different in Europe versus China, for example, is the high penetration of the lease market, right? Lease sales, especially in premium, are so high that any fundamental changes in price, any radical shifts in price, will immediately hit your residual values. And when that happens, that's going to have an impact on monthly rates for consumers, and that just makes things very complicated.
And I saw your August sales numbers were up something like 72% year on year, though it is, again, another challenging backdrop, the slowdown of the Chinese economy. Do you think that could bear on your expansion plans? Is this a difficult time to be making these aggressive moves out of the market?
Yeah, I think if you look at, of course, the economic situation, whether you look at China or European Union right now, how inflation will evolve, what will happen with interest rates, disposable income, but also, you look at leasing, like I said, where lease rates are going to go. That's something that we're watching very closely. But at the same time, you look at the momentum in the market, the desire to shift to EV, it still makes it a great opportunity.
And in terms of, I saw that you've also filed for an IPO in the United States, but you're not entering the United States market. Talk to me about the thinking behind that. Why not list in Europe?
Well, I think, the U.S. is always going to be the U.S., right? And the capital markets there are just the strongest anywhere. So I think that's important. For the US, we already have an active presence through our collaboration with on the fully autonomous vehicle with Waymo, right? As you know, the latest Waymo product that will be released is developed fully by us, and in fact, developed by our R&D center here in Europe. And this is one of the most advanced driverless vehicles that are going to hit the market.
And we've talked about driverless vehicles for a very long time. I wonder if you can be brave now. When do you think we'll see the first autonomous cars on the roads, and in what market do you think that will hit first?
I mean, it's a factor of many different things, right? You need to have the right conditions, meaning you'll see some cities be much more active and much more advanced than others in terms of developing smart grids and things like this. On the other hand, from an OEM perspective, is rolling out that capability in use cases that actually make sense to consumers. So you might see closed loop systems advance a lot faster than kind of open world use cases. We will start seeing that evolve. The first step, of course, is from L2 plus hands-on, moving to a kind of L3 hands-off. That's going to be the first important step. Also because there you have to confront the big issue, which is liability.
And what kind of volume would you like to be doing in Europe in, say, 5 years from now? How many cars do you think you can move here?
We haven't announced volumes concretely, but what we are aiming at is that by the end of the decade, we want to be on the podium for the pure premium EV players.
I see. And then in terms of the margins, what are you looking at in these sorts of cars? What is the kind of profitability outlook for Zeekr?
Yeah, we're not disclosing profit margins, as you can imagine, at the moment, but I think because the fundamental issue for us is that, or the fundamental opportunity is because we design pure EV from the ground up, we can think about that cost structure of the vehicle, that the bill of materials really reflects a true value proposition to the consumer.
And at what point what kind of volume would you have to see to start thinking about potentially looking at manufacturing operations? Obviously, there is a sort of a protectionist impulse we're seeing a little bit. We still want to stay friends with everybody, but we really want people to produce things locally. Is that something you're thinking at all about, or is it a little too early for that?
I think anybody who's not contemplating what it would mean to manufacture in Europe is probably not doing their homework correctly. I think for us, the huge advantage that we have as Geely Group is simply the fact that we know how to produce in Europe, we know how to do it at scale, we know what supply chains look like, we know what labor looks like here, we know what logistics looks like here. So for us, it's not a question of how will it happen and so on. When we decide that the moment is right, we have an advantage in terms of moving quickly.
And then what do you think is going to be the hardest part about expanding in Europe? Is it just the sort of brand awareness and really telling people that you're out there?
Yeah, I think that would be the single biggest challenge, is how do we grow the brand recognition? And for that, what we've said as a strategy is that we're not looking to enter a market and dominate the entire country in one shot. We're kind of more city focused, looking at, hey, if we're entering Amsterdam, how do we do a great job in Amsterdam and let that ripple out? So it's much more cost efficient from a marketing perspective as well.
Spiros Fotinos, thank you so much for joining us on Bloomberg. There you have it. The Zeekr Europe CEO talking about the expansion plans. The cars are literally on their way to meet the roads of Europe.
Oliver, thanks so much. Oliver Crook there at the Munich Auto Show, who, of course, has been there all day with fantastic conversations, really just showing the amount of different brands and we should point out Chinese brands hoping to crack into this market. Now, China also crucial when it comes for the European growth trajectory. Been speaking with a lot of guests about just that. Sophie Lund-Yates over at Hargreaves Lansdowne told us that she wasn't yet ready to say that the stimulus measures that have been done in China and what they will likely do are enough to say European growth will be supported. Of course, Citi telling us that recession bets for Europe, he's not buying on to that, and that there will indeed be another rate hike. At the moment, though, this market pricing in a less than 30% chance that we will see the ECB go again in September. That was the drag lower in yields that we saw on Friday. Some of that undoing itself, not a whole heck of a lot today, but still front end of this German curve is moving higher by about 3 basis points, trading just over 3%. Again, some of the optimism from this is coming from China, that some of the mortgage measures for first-time home buyers, things like stamp tax duties, all of that support is having an impact. So the euro, that's trading stronger just below 108. European stock 600 up 0.25%. Of course, we're trading today without the U.S. It is the Labor Day market holiday. Futures are still trading, though cash markets are not. The Nasdaq leading there, up nearly about 0.25%. NYMEX crude, that trades weaker, but still near a November high. All right, that does it for me on this Labor Day holiday. Coming up, Tom McKenzie will take you through the rest of the market's coverage. This is Bloomberg.